What's up, investors? Today we are going to talk about why the price of stocks rises and falls. You see, the main goal of investors when buying and selling stocks is to make a profit. And this can be realized by expertly capitalizing on the difference in market prices. The price is set on the exchange by the market participant of the trade. Let's talk about some of the key factors that affect the price changes on the stock market. Don't forget to subscribe, give this video a thumbs up, and ring on the notifications bell. My name is Angie. Let's go. First, let's talk about the supply and demand. Buyers form a demand for shares on the market, while sellers, on the other hand, create a supply. Buyers and sellers make transactions depending on how they value the business of different companies, which is then reflected in the price of the respective stocks. If the majority of traders' expectations for a company's business is optimistic, then more and more people will want to buy the stock. Demand will exceed supply, and this will lead to an increase in the price of the shares. Let's imagine, for example, that a company just launched a new and unique product that could capture a significant portion of sales in the market. The company's business may grow in the future, which means that by buying its shares now, after some time, it will be possible to sell them at a higher price to make a profit. Demand for such companies, demand for such companies' stocks will exceed supply, and the price of shares will rise. We can actually use Apple shares as an example. Every year, the company presents its new line of products, and if Apple's innovations are interesting, its shares will continue to rise. For example, we can look at the Apple shares in March of 2019 when Apple announced their upgraded and long awaited products. And we can see how the price increased significantly. If, on the contrary, expectations are pessimistic, then traders will try to get rid of the shares, and the supply in the market will exceed the demand. Let's imagine that a company has published a report that makes it clear that the company's debt has grown tremendously, and this is a factor that could have a negative impact on the business in the future. Traders will rush to sell the shares because the risks of investing in such a company are much higher and outweigh the chances of making a profit. So, supply will exceed demand and the price of shares will fall. If the supply and demand is about equal, the price will not change much. It will fluctuate within certain levels. This situation is possible due to uncertainty in the expectations of market participants. Secondly, my friends, we have to consider the general situation on the market. If most stocks on the market are either rising or falling, this can have an effect on a single stock, even if there are no other present factors. This is because the shares of the company may be included in the portfolio of investors in a certain ratio. And in a situation where the majority of shares in the portfolio begin to fall, investors are forced to sell some of the good shares as well in order to maintain the desired proportion of securities in their portfolio. Additionally, the price of shares may rise and fall due to psychological factors. For example, with general optimism on the market, demand can grow simply because traders are in a good mood. We often observe this kind of situation before the new year. It's called a pre New Year's rally. It begins in the markets, and the shares of many companies grow for no reason at all. I have this example right here for the Dow Jones. In 2020, in November and December, the Dow Jones index grew by 14.6%. On the other hand, in the event of a major market collapse, pessimistic sentiment amongst participants can cause prices to fall even without valid reason. On the bottom here, this is the same asset. I have the Dow Jones up top, and on the bottom, this is the New Year's rally, and this is the market collapse that we observed in March of 2020. The Dow Jones fell from 27,000 points to 18,300 points. And even stocks of companies that were not affected by the COVID pandemic also fell. And thirdly, my friend, unforeseen circumstances. Unexpected layoffs and promotions within a company may affect the business and cause failures and disruptions in work. These events are quite often unpredictable, but they have a direct impact on the stock's price. Most often, the impact is negative, but there are some exceptions. You see, any unforeseen situation that can have an effect on the operations of a company will cause traders to get rid of the company's shares as soon as possible to avoid additional risks. But in some cases, an event that can have a negative impact on one company can have a diverse effect on another. And in this case, the price of these companies will move in different directions. And so, my friends, we can see that there are many different factors that can have both a positive and a negative effect on the price of shares. When compiling a portfolio, it's best to consider all of them if possible. Make sure to watch the rest of our videos on stocks on our channel. So subscribe. If you enjoyed this lesson, please give me a thumbs up and ring on the notifications bell. Likewise, my friends, I do hope to see all of you on our social networks. Thanks so much for tuning in, and I will see you next time. Bye bye.